Welcome to the Small Business Coffee Break, the video series where we take a few minutes to work on your business, not just in it. Today we ask Sara Hernandez, Senior Vice President of First Citizens Bank Coral Gables about, is it a bank's job to loan money? Sara has over 15 years of experience helping small businesses with their financing and banking needs. Unfortunately, we did have some slight sound issues while recording with Sara, but we thought the information she was providing was so valuable we're bringing it to you anyway. So grab a cup of coffee and let's get into it. So Sara, we've talked about how banks approach a prospective client, and sometimes you have to say no. And in my industry, I get the question about how insurance companies, shouldn't they be in the business of doing risk, which isn't quite the way it works. So I'm going to ask you the same question. Isn't a bank's job to loan money?
Yes, it is. However, we have to make sure that the money that we lend out is going to be repaid, because we have an obligation to the stakeholders in the bank. Everybody that has money in the bank wants the bank to succeed. So if you have an account in the bank, you don't want me to be lending money to people that we can't ascertain if they're going to pay us back, that they don't have a history of good credit, that they don't have a history of income. You have to make sound investments. And so that's what we do.
So what I'm hearing, which is really interesting, every loan a bank makes is an investment in the stakeholders of that particular bank, whether it's a bank that's owned by the constituents of the bank or a publicly traded company. I don't know if I ever thought about it that way. Most of the time I'm thinking that the investment is what I got the loan for, right? I have a business and I want to invest in something, so I took out a loan. Right. So, but I think what an eye-opener it might be if we considered, as I'm approaching a bank, that what I'm looking for is their investment in my business,
right?
And what that means.
And you want to position yourself in such a way so that the bank sees that as a good investment. Mm-hmm. Right? So the more you know about what you're looking into doing, the more information you have, the more research, all of those things creates more sense of stability on the banker on the other side of the desk, basically.
Whether or not they're willing to make that decision one way or another.
The other thing that a lot of people don't realize is banks are highly regulated by the government. And so when a bank makes bad investments and has a lot of loans go in default, they can lose their charter. They can lose the ability to be in business.
Right, so that's what a charter is, right? It's like
right.
their permission, license, for lack of a better description,
exactly.
In order for them to be able to do what they do,
exactly.
And how they do it. And obviously, if they lose their charter, they lose all of their investments.
Right, and the regulators come in, once a year. They come in and they audit the books and they look at all of the loans and they see the loans that have gone bad. They see what the past dues are. They want to go through everything, right? So the last thing that an enterprise as a bank wants to do is make loans that are going to look bad on the books.
Right. Let's keep the conversation going. If you have any questions you'd like to ask Sara, ask them in the comments, or her contact information is in the description. If you have any questions you'd like me to ask Sara or any other professional in their field, my contact information is also in the description, and I'm always available by DM. See you next week for another cup of coffee and more questions answered.